to go across. We have Neelkanth Mishra joining us, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkanth, it's always great chatting with you. Marquee voice to try and understand how macros are doing, and especially at a time when macros are the big movers of the last few weeks. Neelkanth, let me start off by getting a sense. It's been a while since we caught up. So trying to get a sense on how you're looking at the GST rate cuts and the impact of that on the fisc. What does this do in terms of limiting government spend? Or do you believe that the government may not curtail spend as much and will continue to push both RevX and Capex? Is there a priority that you're seeing with regard to how this will be going forward? Or do you just believe that revenues, given volumes will be stronger, that revenues will actually catch up, government revenues, and therefore very low impact on the fisc?
No, I don't expect any impact from the on the fiscal from this one, and we've written extensively about this. To understand this better, it's important to think about the compensation cess. The compensation cess in the first few years of GST was being collected and then spent, meaning it was paid out to the states and the states then spent it. In the last 2 years of GST, the requirement for compensation was significantly higher than the cess being collected. So the central government was borrowing, and this was off-balance sheet borrowing. So in a way, the fiscal deficit in those 2 years was higher than what the official number suggested. And then the state governments were spending in a way more than what the tax collection was. In FY25, which is the last fiscal year, the compensation cess was being collected, but it was being used to repay the loans taken in FY21-22. So and the interest on that. So in a way, the tightening in FY25 was not just 80 basis points, which was the headline consolidation, but an additional 50 basis points. This year, or starting 22nd September, that 0.5% is being deployed into effectively the GST rationalization. So, which is the reason why you have seen that neither the state governments nor the central governments have increased their borrowing target. So there is no direct fiscal implication of this, just because a large part of the cuts are being funded by what was earlier called compensation cess. In terms of priorities, I don't see any change in priority for the government. The focus on infrastructure build out remains, and I expect that as discussion on next year's budget starts, I think the focus will remain on the construction of infrastructure.
Hi, morning, Sajid here. We're seeing a lot of global headwinds coming in, especially with respect to crude and the Russia sanctions which have come in. What kind of impact that will have for the Indian economy? Have you done a basic assessment of how it will change the dynamics here for India's crude sourcing and other issues?
See, so every dollar per barrel is about $1.7 billion a year. So if there is a $10 per barrel impact, I mean, we are not seeing that yet, but suppose that happens, there is a $17 billion, $18 billion impact, which is give or take 0.4, 0.5% of GDP. But remember that the last year average was upwards of 70. So given that this rise has begun from about 61, 62, I think from a year-on-year basis, this is not a drag really. The second question is, how long will this last? So in a way, this is, as with most things regarding President Trump, a bargaining tactic. This is because he has been unable to bring Russia and Ukraine to the negotiating table. The assumption is, or we should run with, is that this will not last 1 year or 2 years. This will last maybe a couple of months, long enough. I don't think you can specify an end date because then the utility of it will die. But assumption should be that it should cause enough pain on all sides that it will not last that long. So either way, as of now, the kind of increase we have seen, if this price was to go to 80 or 85 or 90, then we are talking about some headwinds to the economy.
Do you think that it has potential to go to 70 or 80, given the fact that Trump is pushing for India and China to stop sourcing crude from Russia?
Remember that there is adequate supply. So the reason why the oil prices from the $70-$75 a barrel actually fell to $60-$62 a barrel was because there was excess supply. Now there are signs also that there is, kind of a global slowdown, and therefore the demand for oil may not remain very strong. Can the world see? Of course, India, we are in the midst of a recovery in the business cycle, and maybe I can elaborate on that later. But the rest of the world actually does not have any of those leeways, and therefore the likelihood that they will also get impacted. Remember that you know oil price increases affect not just us, but also prices at the pump in the US, in Europe, in China. So there will be headwinds everywhere, and how long this lasts, we'll have to see. The potential of oil prices going to 75 or 80, if there is another disruption, suppose in this context, some terror group in some African country or Latin America or someplace goes and disrupts, and therefore oil prices spike up again, then we will have to assess that. But at this stage, I don't expect these kind of barriers to, one, last very long, and second, for prices to really push up above $80. Because I don't think the world in this growth stage can absorb those kind of price increases.
So that's the take on crude. Neelkanth, hi morning. This is Nehi also joining in. Once again, want to shift your focus on the trade deficit that we have at 32 billion. This was the highest we've seen in about 10 or 11 months gone by, and this was largely led by the imports of gold. Now, if gold import continues to surge and the current account deficit widens beyond comfort levels, what do you think the next policy stance could be?
That's it's a very important question, because a number of people misinterpreted the increase in deficit to be an impact from of the slowdown in exports to the US. There was some impact, but I think bulk of it, as you rightly said, was because gold imports surged. So of the $7 billion year-on-year increase in deficits last month, about $6 billion came from gold itself. A large part of it, I think, is a seasonal effect, meaning that because Diwali this year was a bit early, a lot of the imports happened in September, and then October and November will not be that high. The tonnage, the implied tonnage of imports was like 82, which kind of analyzes to 950 to 1,000 tons a year. Average gold imports in India, and you can go back 20-25 years, is between 550 to 750 tons. So this was well above average. So once you normalize it, the pressure on the trade deficit is not that significant. I think we will be in the 1%. The current account deficit ratio should not be well above 1%. One of the big changes that is happening now, and maybe I should elaborate on that, is that we are at the cusp, at the turning point of a cyclical recovery. As I explained, in FY25, we had not 80 basis points, but 130 basis points of fiscal consolidation. Because credit growth had slowed very sharply from 16.3% year-on-year in March 24 to 9.8% year-on-year in May 25, and since then has started to recover. So if you think about a 6.5% point year-on-year decline or fall in year-on-year growth, it actually was a drag of 2.5 to 3% of GDP. So the reported number in FY25 was 6.5%. This was despite 130 basis points of fiscal consolidation and a 250 to 300 basis point impact because of slowing down of credit. Some of it was, of course, nominal. So therefore, the trend growth is actually quite strong. Now, this year, as the fiscal consolidation effectively is a lot lower, and the monetary easing is starting to become effective because of the GST cuts, the growth rates are actually going to be picking up from here. So as our expectation is that by March, the exit rate from this fiscal year of growth will be significantly stronger than where we are now. Now, which would mean that your import burden will go up. So that pressure and how much of that increase is met with internal demand, how much of it results in an increase in the current account deficit, we'll have to see. The comforting factor for us should be that capital flows to India are dependent on growth and not interest rates. And therefore, as growth revival becomes visible, I expect that capital flows will also start to pick up. I was in the US and UK meeting investors the last 2 weeks, and I was surprised to see that India was being categorized as an AI loser and Taiwan, Korea as AI winner. So over and above the fund outflows that are happening from Asia and EM funds, funds were taking money out of India and putting into Korea and Taiwan. I think those are very narrow-sighted views. There is a business cycle. As the evidence of the growth revival becomes clearer, I think the capital flows will come in. So funding say 1.5%, 1.6% of GDP worth of CAD, which could be the exit rate this year, should not be a challenge.
The exports, they have been softer so far, and especially exports to the US were front-ended because of the tariff there. Do you see exports to remain soft in the second half as well, given the fact the higher tariff would be preventing many of the Indian companies to export to the US?
There has been a slowdown. In some of the worst affected sectors, there's been enough narratives on how the inquiries themselves had stalled. So if you are talking about a 50% import duty or export duty, there is a huge problem. So there has been a bit of a slowdown. And the expectation is, the assumption is that if this 25% extra duty was because of Russian oil, and as we discussed early on, these purchases are being curtailed because everyone is being forced to do it. Even Chinese are apparently cutting down consumption or the imports from Russia. As that starts to happen, I think the likelihood of that extra 25% going down is very high. We've had the Commerce Minister say yesterday that the discussions are going on well. So we should not assume that this 50% duty will remain throughout the year. Also remember that these are not automatons that there's only one direction in which exports can flow, and if you put exports on that path, then the exports will stop. And remember that businesses and entrepreneurs are very resilient. They are very adaptive. So we are already seeing, in fact, there are enough news reports that the exporters are now reaching out to other geographies and creating pathways where the capacities in India can be redeployed. So I don't expect this to be on both fronts. One, that this 50% duties should not last, and secondly, that the ecosystems are adaptive. If say $2 billion of apparel exports become unviable to the US, we are talking about 200,000 people. And you can't find 200,000 people very easily. So if say in Vietnam or Bangladesh or Pakistan, they have to find 200,000 people, those people would have been supplying somewhere else. So this becomes mostly a trade diversion kind of analysis, and therefore the lasting impact of some of these will be a lot lower than what the headline numbers may suggest.
Neelkanth, I know you hinted at the fact that there could be upside surprise to growth, India growth. How much could that possibly be? Have you had a chance to rework the numbers? And what about FY27 therefore? Because H1 will be a positive tilt where FY27 is concerned, but H2 might have a higher base. So trying to understand how those numbers will work.
Yeah, so I think base effects do have a role to play in terms of the headline numbers, but what the markets respond to and investors track is the actual growth momentum. And I do think that through FY27, the growth momentum should remain much better than what we saw in FY25. So consensus numbers have been upgraded. You must have seen even the Monetary Policy Committee upgraded its growth forecast, but The interesting thing about the MPC's growth forecast was that almost all of it came, actually, all of it came from just the first quarter growth surprise. So the second, third, and fourth quarter numbers were actually revised downwards. So most of the consensus upgrades to GDP have actually been more a response to the first quarter growth surprise. I think consensus is at about 6.5, 6.7. My view is that the full year number can be upward of 7. Next year as well, now I think we should be clocking. We are yet to do our full analysis, but I wouldn't be surprised if the next year real GDP growth comes well above 7%. The reason I'm saying this, and the reason for this hypothesis, this is still something that we are working on, is that if your reported growth is 6.5% in FY25, and this is despite significant fiscal consolidation, as I said, 80 basis points of explicit and 50 basis points of implicit, so 130 basis points of fiscal, and a further drag from the sharp slowdown in credit growth, then as the monetary policy becomes more relaxed and credit growth starts to pick up, and the fiscal tightening is no longer as adverse, maybe the trend growth is actually not even 7, it may be higher than 7. And therefore, I think a growth rate, so significant 50, 60 basis point upgrade possible to say FY27 forecast for consensus.
Neelkanth, what's the take with regard to credit growth? Because credit growth in Q2 came as a huge positive surprise. Do you believe that that kind of a number is sustainable? So on the larger banks growing at 4.5%, that's sequential, and that was a huge positive surprise.
It was a positive surprise in the sense that it happened a few months earlier than we expected. So I think consensus also is expecting end of the year growth of 12-13%. I think there was a lack of belief on those forecasts in the market. The way to remember that the financial system is massively well capitalized. So this is the first cycle or first upturn that we are seeing, where even the PSU banks do not have impaired balance sheets or have to digest some of the sins of the past cycle. On top of that, several of the small banks have raised massive amounts of capital, and the largest banks already have 15% plus tier 1 ratios and all that. So this is an incredibly well capitalized banking system. There were two issues. One was a chronic lack of liquidity in the previous fiscal year. On top of that, there were also regulatory concerns and burdens that as you must have seen in the last MPC and the RBI decisions that accompanied the last Monetary Policy Committee decision, where there were 22 measures to relax regulations on banks. So as the regulatory relaxation also starts to happen, I think the banks are getting emboldened and responding to the signals from the regulator and dialing up the risk dial. See, in credit cycles, generally secured credit is acyclical. The assumption is always or should always be that if there is an asset which can be used as collateral, the borrower or the lender would have some borrower or some lender would have already used it as collateral. So business cycles are always about unsecured credit, and unsecured credit, as you know, is less about interest rates. It's more about risk appetite. So as the regulator has very firmly indicated in so many words that growth is below our aspirations and that they want credit growth to pick up, and in the process they are responding to feedback that it was regulatory tightening as well, which was slowing down credit growth. So if there are such strong signals coming up, I think it is natural for the banks, which remember that they're, especially the private banks, have significant incentives to grow, and they are well capable of growing. And therefore, with the GST cuts coming through, I think the credit growth has started to pick up. The bigger question is, will FY26, where consensus I think is at 12-13%, will that end the year at higher growth or not? My sense is that it is quite possible that we could see a slight surprise to that as well.
Okay, Neelkanth, while we're talking about credit growth, I was going through your report and some very interesting trends I spotted over there. NBFCs, in terms of the kind of loans they're dispersing, MSMEs now, and PSU banks on one side, they're losing share as well. The kind of churn that we're seeing when it comes to credit partaking, do you think this is just a structural deepening on one side, or do you believe this is just a near-term liquidity-driven churn that we're seeing when it comes to credit lending?
That's a great question. It is a structural deepening. So you will see that there are new to credit customers, and the government also is. Okay, let maybe take a step back and look at a system where the bank credit to GDP is 56%, which is maybe half of what it is in any comparable economy. Total system credit, if you add corporate bonds and NBFCs, is maybe around 80% of GDP. This is a number which can and should expand significantly as we go forward. Now, will this happen only through the rise in consumer credit? I don't think so. This is where the MSME story comes up. And the attempt of policymakers, the industry, and the government has been to deepen this market. So can we get more and more companies to come into the formal credit ecosystem? So there has been, of course, the flush of liquidity helps. The fact that cost of funding for NBFCs has come down substantially. The AA, AAA bond yields are down much lower, also helped by the government's fiscal discipline. So that definitely helps. But equally important is the fact that there is a lot more data-based lending now. So India's digital public infrastructure, the fact that GST invoices, GST transactions, once validated, are also data that people can lend against. And this is where the risk appetite comes in. So as the risk weights on NBFC loans for banks were brought down, some of the restrictions on NBFCs were relaxed. The credit, the risk appetite, and therefore the growth impetus coming in from some of the NBFCs have been quite strong. So in the less than 1 crore and the 1 to 10 crore loan segments, NBFCs, which for MSMEs are only about 11% of total loans, the new origination share in the less than 1 crore and 1 to 10 crore segments is actually 25 to 33%. So they're actually getting into business loans. So even lending to the NBFCs or to the small businesses, MSMEs, there can be various types of loans. So most of the commercial banks tend to focus on working capital loans, overdrafts, which are slightly safer. The slightly riskier growth-focused business loans, etc., this is where the NBFCs are also, I think, playing a big role. So, and that's how, in a way, the system is architected. So if you think about, say, the Roman Empire expanding, on the borders of the Rhine, there are these. So there are people who have to really clear the woods, spread civilization, and then over a period of time, the main financial system also becomes comfortable lending to them. So NBFCs are playing a big role, and I think they're a very big part of the growth process.
Neelkanth, you're penciling in over 7% growth for FY26, a credit growth of 12 to 13%. How are you looking at the Capex cycle? Private sector Capex is slow to start, and I think public sector Capex is, I think, overstated, if I'm not wrong. But how do you look at the entire Capex cycle?
I have a slight disagreement with your assessment that private sector Capex is not happening. The data shows that it is happening. So I'm actually quite surprised, and everyone who says private sector Capex is not happening, so I have to ask them based on what data, because it's one of those things that it's very safe to say it because everyone else is saying it. But you look at data, the FY25, in a year where the economy was slowing, the investing cash flows of the top 200 companies in India actually grew 18% year on year, which is well above nominal GDP. Even if you remove the M&A, the mergers and acquisitions, the actual Capex grew at 13% year on year, which is again ahead of the nominal GDP. of the total 31%, 32% of GDP worth of GFCF, which is gross fixed capital formation, which is actually the most comprehensive measure of investment in the economy, the central government accounts for only about 3.1%, basically 1/10 of the total investment. So whether the central government capex is growing by 11% or 12% or 13% or maybe 15%, it adds maybe a few decimal points. I think it's far more important to look at what's happening to the real estate cycle. Even through this slowdown, what has been remarkable is that cement and steel demands in terms of volumes has been quite robust. So we've seen high single-digit volume growth. Of course, last year's base in the first half was a bit lower as well, so we'll have to see how quickly it picks up. But as the liquidity is coming in, as risk appetite is coming through, I think the real estate cycle, which had been very strong for 3 years post-COVID, and then we saw a bit of a lull because of the monetary tightening and the sharp slowdown that happened in FY25. But I think there are early signs that that cycle is picking up as well. So if the real estate cycle does well, I think the power generation cycle does well. The overall investment ecosystem, the investment to GDP ratio in the next 3 years could actually reach 34% is our forecast. So
Okay.
one, we do not think that private sector capex is doing badly.
Okay.
We have seen large industrials companies report the same. And second, I think that it's likely to improve from here, driven by the real estate cycle and
Right.
the start of power generation capex.
Okay, Neelkanth, so much to watch out for, and thank you so much for such a lovely conversation, and hope to catch up with you again as well very soon.
Right.
Okay, viewers.